I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guy who is an expert money manager. He manages big money, also an expert in finance, but he's also a three-time best-selling author. His latest best-selling author is this book that came out just a few years ago, a revised edition called The Real Crash. Of course, there's a big giveaway here. It's Peter Schiff, and I want to bring him on. Peter Schiff, thank you for joining us today on USAWatchdog.com.
Thanks, Greg. Thanks for having me on again.
You know, I want to compliment you on you take very complicated things and you make a reasoned argument, and if people hear it and go, oh, yeah, that makes sense. Oh, that's the truth. And I wanted you to get your take. And this got glossed over on Monday night's debate and all the post-debate analysis. And that was Donald Trump talking about the Fed, and Janet Yellen is being totally political, and she's blown a bubble. The Fed's made a big mistake, and if they raise interest rates, it's going to be very, very bad, very bad. Can you explain why Trump is saying what he's saying and what it means to Americans?
Yeah, I certainly wish Donald Trump did a better job of actually explaining what he's saying. And, I talked about that, by the way. If you really want to get my complete take on the debates, I just recorded earlier this morning my critique of the debates and my opinion on what really Trump should have done and the opportunities that he missed on my YouTube channel, the Schiff Report. So sometime after you finish watching this interview, check that out to get a more complete assessment of my take on the debates. But first of all, when it comes to explaining the Fed, a lot of people are already criticizing Donald Trump's critique because they say, well, on the one hand, he says the economy is weak, but then he says the Fed should raise rates, and then on the one hand, he says that if we raise rates, a lot of bad things are going to happen, but then he criticizes the Fed for keeping rates low. So which is it? Right, he's trying to have his cake and eat it too. What Trump has to explain is that low interest rates don't help the economy. Low interest rates are one of the biggest headwinds for the economy because all they do is inflate asset bubbles and prevent legitimate economic growth. And Donald Trump has to explain that even though rates have to go up, that when they do, it's going to burst the bubble and it's not going to be fun. It's going to be another financial crisis, only worse. But the problem is, if we're ever going to have a real recovery that's going to produce a higher standard of living and the good paying jobs that everybody claims they want, we're not going to get there unless we let this bubble deflate. And that means raising interest rates and having to live with the consequences, which are going to be a collapsing stock market, a collapsing bond market, a collapsing real estate market, failing banks, a repeat of the '08 financial crisis, only worse. And all Janet Yellen is succeeding in doing by keeping rates artificially low is exacerbating the problems and delaying the day of reckoning.
How close are we to this happening? Whether the Fed raises rates or not, aren't we teetering on a very risky market no matter what the Fed does?
Well, absolutely. And I disagree with Donald Trump that the Fed is going to raise rates as soon as the election is over. I think they're likely to cut rates when the election is over. I think they're going to launch QE4. I think the reason they're not doing it now is because they want to pretend that the economy doesn't need the help. They want to pretend that we still have a legitimate recovery. But once the election is over, they can drop the pretense. They can come up with some excuse. But the last thing the Fed wants to do is raise rates. Certainly, if Hillary Clinton is the next president, the Fed doesn't want to prick the bubble as soon as she takes over the helm. So they're going to do everything they can to keep the air in this bubble for as long as they can. But Trump is right. It is a gigantic bubble. It is going to burst, and it is going to be a disaster.
Well, when you say disaster, does that mean that the credit markets will seize up? Your credit cards won't work. They'll have bail-ins at the banks. Give me the list of the disaster, what people are going to feel when this credit market busts.
Well, they're going to feel what they should have felt in 2008 had we not had any of the bailouts. If you remember what so many people were worried about when it came to bank failures, we would have had that had the Federal Reserve not bailed everybody out, had we not had the quantitative easing, had we not had the 0% interest rates. So the next time around, we're going to have to deal with the full consequences of the mistakes that have been made in the past. But these mistakes are a consequence of the Fed keeping interest rates artificially low. Because they've done that, we have much too much debt. Look, Donald Trump pointed out that under Barack Obama, the national debt doubled. But he didn't point out that it also doubled under George Bush. And the reason it doubled under both presidents is because the Fed made it all possible. But the Fed let everybody lever up, not only the government, but households, corporations. We've all borrowed money that is impossible to repay. And the only thing between us and a crisis is interest rates that are practically zero. But they can't stay there indefinitely without destroying the dollar. And I think ultimately that might be what gives, is because they try to keep rates low so long, because they realize how painful the corrective process is going to be, that they destroy the dollar in the process. And what ultimately causes the Fed to raise rates is because they don't want the dollar to become monopoly money. They want to make sure it doesn't lose all of its value, just a considerable portion of its value. And reluctantly and eventually they're going to have to raise interest rates, and not just a little, but a lot. And then this whole house of cards is going to come falling down, and we're going to have to deal with the consequences of these mistakes.
So the end result in your mind is going to be some pretty heavy inflation.
Well, I think it's going to be heavy inflation. I hope it's not hyperinflation. I hope we ultimately get the rate hikes that we need to prevent that from happening. But then we're going to have the complete collapse, and we're going to have to deal with these problems. And, you know, one of the things that Donald Trump is backing away from, and I think he should embrace it, is his idea that we need to restructure the national debt. And we absolutely must, because it is impossible for us to repay the $20 trillion of Treasury debt. In fact, it's impossible to service the debt if interest rates rise to a market level. Certainly if they rise to a high level to combat inflation, there is no way we can honor these commitments. And I would rather restructure and ask our creditors. Many of them are very wealthy. Many of them are foreign. Many of them are foreign governments. Why should we have massive tax hikes on the American middle class so that the Chinese can be repaid in full for the money they were dumb enough to lend the U.S. government? So we've got to come to terms with the fact that we are broke, that we've borrowed more money than we can ever repay. And in the process, we have created a phony economy. We have created a service sector economy. We have enormous trade deficits, and they don't result from bad trade deals. It's not NAFTA that's the reason we have these trade deficits. It's the Fed, it's the artificially low interest rates, and the fact that we don't have our own savings to invest in capital. It's because of excess regulation and excess taxation that Hillary Clinton has promised to double down on. We need less government. We need freer markets. We need to produce again. But none of that is going to be accomplished until we raise interest rates. And we can't raise interest rates without pricking the bubble. So it's like, you know, we can't have the gain without the short-term pain. But politically speaking, nobody has the stomach for that pain. And so we never get the gain because we keep making the problems worse.
Some of the pain is like the Dallas and police and fire departments. Their pensions are in big trouble. Many other pensions, the truckers had the truckers union, the truckers pensions are in big trouble. That's one of the pain that's some of the pain you're talking about. Pensions
they're all in trouble. They're all in trouble because politicians have promised voters something for nothing. A lot of government workers have been promised pensions, but the taxpayers have never been asked to fund the pensions, and neither have the workers. And so they're empty promises, and there's no way they can get kept. That is the bad news. So there are two possible scenarios. We come clean, and we tell people that they're not going to get everything they've been promised, or we try to pretend that everyone's going to get paid, and we pay off all the promises with worthless money. I think it's better to be honest and restructure these obligations in a way that we can actually afford to pay them, rather than just pretend that we can afford it and we print a bunch of money, destroy the value of the dollar, and then everybody gets their pension, but their pensions are worthless because you can't buy anything with the money.
What about the Chinese currency being let into the IMF's special drawing rights, SDRs, what they call it? It's going to displace somebody. There's a lot of doom and gloom about that on the internet. I know you know all about currencies with Euro Pacific Capital. That's the money you manage. Also Schiff Gold. You know all about this dynamic. Chinese have a lot of gold. What is going on with? What do you think is going to happen when they include the yuan into the IMF's basket of currencies?
Well, I think the yuan is going to have a substantial rise against the dollar. You have a lot of hedge funds that are short that currency, and I think they're going to lose a lot of money when that trade unwinds. I think some of the same people are short the yen and the euro. I think those currencies are going to rise against the dollar as well. I think they're all going to fall against gold and maybe against some other currencies, but they're going to rise against the dollar, and that has serious implications for America. One of the things that nobody seems to understand, or Trump doesn't even point out, is that in the short run, the Chinese have been supplying a massive subsidy to the American economy. In the long run, they're not doing us any favors, but in the short run, they're making our lives better in that they supply us with the consumer goods that we need and we want, and they loan us the money to buy them. Because we have this huge trade deficit with China, that means we're getting a lot of stuff from the Chinese that we're not paying for. So we get all sorts of products that make our lives better, and they just get little pieces of paper that they can't do very much with. And in fact, more recently, they've been waking up. If you look at what's been happening to Chinese holdings of U.S. Treasuries, they've been going down, while Chinese holdings of gold have been going way up. So they can obviously read the writing on the wall, even if we can't. But eventually, in the idea of being careful what you wish for, when we talk about, hey, we need to, China has to stop manipulating its currency, right? That means the Chinese currency goes up, and that means our standard of living comes crashing down, because now all the products that we've been buying so cheaply at Walmart, all of a sudden they triple in price and nobody can afford them. So this is going to be a rude awakening for the average American when he finds out just how broke he really is.
When you say triple in price, you're serious. You're saying that prices in a short amount of time could triple?
Yeah, whether it's double or triple or how long it's going to take, but prices are going to go way up. Eventually going to Walmart is going to be like going to Neiman Marcus. The prices are going to be very, very high. And that means Walmart is not going to sell as many products in America, which also means they're not going to have to employ as many Americans. And so there's going to be a lot of layoffs. But in the meantime, the products that China used to ship to Walmart in America, those products are still going to be made. They're just going to be on a shelf in some Chinese Walmart. And now the Chinese people are going to get to buy products that before they didn't have, because Americans were buying them because Americans were richer. But when the U.S. dollar crashes and their currency goes up, the Chinese gain the purchasing power that we lose.
And I want to get into Deutsche Bank. It's been called the most systemically dangerous bank in the world by the Fed and the IMF. And boy, they are on. Last Friday they were $13 a share, and come Monday they were $11.85. That is a bad trajectory. In less than 10 years ago, they were $140 a share. Deutsche Bank. What's your read on this possible? Let's call it a gray swan of Deutsche Bank.
Well, look, there are a lot of problems in the financial sector, not just Deutsche Bank. And Deutsche Bank not only has the normal problems, but you have the U.S. government trying to fine them, $14 billion or something like that. But I have avoided the financials for years. That's one of the reasons that the funds that I manage, the mutual funds that are separately managed accounts, are so outperforming the benchmarks this year, is because the benchmarks have a lot of financials and we have none. And what really I think is crazy is you see all these analysts talking about how higher interest rates are going to be good for the banks, right? Because they're going to have better margins on their loans. So we want to see these spreads go up. These analysts have no clue what they're talking about, because the banks have these toxic balance sheets, and higher interest rates are going to be like a bomb that's going to go off. Because when rates go up, the value of their portfolios is going to collapse. You've got banks that own these long-dated assets, and the collateral for their loans is going to lose value when rates go up. Real estate prices are going to come down. There's going to be all sorts of problems that the banks are going to be confronted with when interest rates go up. But also, if interest rates don't go up, the banks are going to have a lot of problems. So they're damned if the Fed does, and they're damned if the Fed doesn't. I don't think there's any way out of this mess for the financials. You know, they got in bed with the federal government in the 2008 bailouts. And you know what happens when you get in bed with the government? Well, that's exactly what's going to happen to these financials, which is why I don't own them. I don't own them with my money, and I certainly don't own them with client money.
So I had a friend of mine that called me up and said, oh, they got a 5% interest rate with a big insurance company. And I said, how in the world? And that's just me, and I'm not an expert market manager, a money manager like you. And I just, how are they paying 5%? Ask them how they're paying 5%. It's a big, well-known company. And when they're offering stuff like this, I mean, Deutsche Bank was offering 5% in the middle of the summer, and they're, in deep trouble. When insurance companies are offering a 5% guaranteed return, is that a warning sign? What's your read on that?
Yeah, well, the only way that you can offer 5% yields in an environment where yields are so low, if you're marketing the product as somehow being safe, right, that it's like a bond or a CD or something, you have to be taking enormous risk. There has to be lots of leverage that is being implored in order to create these returns. So I think people have no idea what they're actually signing up for if they're going to buy into this, because you cannot legitimately deliver that kind of return unless you're going to take a lot of risk. Now, what I choose to do, because I have a lot of clients who want yield, and we get much more than 5%, but we do it buying common stocks. We do it buying stocks that pay dividends in countries like New Zealand or Singapore or Norway or Switzerland. But we're upfront with the clients that, hey, you're a stockholder. There's risk here. The stock could go down. There could be a problem. But when people are trying to package a 5% return as if it's low risk, then you better believe that you're taking enormous risk. And eventually it's going to blow up when the Fed is forced to raise interest rates. And if the Fed never raises interest rates because it's cognizant of all this, then it's even worse, because you get your 5%, but there's massive inflation and the money isn't worth anything. So you lose either way. You lose because the Fed raises rates and your investment blows up and you don't get your money back, or the Fed doesn't raise rates and the dollar blows up and you get your money back, but you don't get your purchasing power back.
How are people supposed to protect themselves? I mean, I tell people all the time, everything's on sale. We're going to end up getting a big inflation, so you should have tires on your car, batteries, gold, silver, artwork, farmland. What are you telling people to do other than buying stocks in your fund?
Well, we're buying gold. We're buying gold stocks. We're getting out of the dollar. The government is telling us, right, that, if inflation picks up, we'll raise rates. That's all part of the lie. Just like they told us if unemployment went down, they'd raise rates. The initial line in the sand was 6.5%. We got down to 5% before they raised rates once, and they haven't raised them again. And, I'm one of the only people, if not the only people, who said when the Fed raised rates in December last year that was the end of it, that it was one and done.
I believe you said that I believe you said it on our show, that you would say that they wouldn't raise rates again. I'm pretty sure. I am sure. Well, you said they wouldn't raise rates again. As a matter of fact, they'd probably turn into more QE to QE4. You said that.
Well, what I said on your show at the end of 2014 or early 2015, that I didn't think the Fed would raise rates at all, because if they did raise rates once, that would be the only time they did it, and then they'd have to reverse it. And I thought they would look more foolish raising them once and then not doing it again than having never raised them at all, because now it looks like they tried to normalize, and then they couldn't do it. Had they never made the mistake of raising rates, then I think they would have preserved more credibility. Of course, not raising rates is the mistake. They need to raise rates dramatically, not just a little bit, but doing that despite the fact that it's going to cause another financial crisis. Because the longer we wait to raise those rates, the worse that ultimate financial crisis is going to be. So let's just get it out of the way right now. But based on what the Fed was doing, I knew that they couldn't raise rates, and then they did it. And then when they did it, they promised to raise, 3 more times this year? I said, there's no way they're going to do that. In fact, when Janet Yellen first laid out her plan 2 or 3 years ago for shrinking the Fed's balance sheet. What did I say back then? I said, this is all lies. She can't do any of this. She's just talking. This is impossible. And of course, so far, the balance sheet hasn't shrunk at all. In fact, even Ben Bernanke, when he lied in 2009 and he told Congress that he wasn't monetizing the debt, he said that we're just buying these bonds temporarily. We're going to sell them when the emergency is over. I called Ben Bernanke a liar back then. I said there's no way that they're going to sell these bonds. And here we are, almost the end of 2016. And not only has the Fed not sold a single bond, every bond that's matured has been rolled over. Every dime of interest they've earned has been used to purchase more bonds. So they are trapped in the very monetary Roach Motel I said they were trapped in from day one.
Peter Schiff, you are very, very clear-headed, very clear thinking. I was trying to give you props because you did say they wouldn't raise rates and that they eventually do QE3 or QE4. I'm sorry, that they're going to do. And I'm holding up your book cover art here again. It's a great book, folks. I mean, this is the real crash. If you want to get this in detail, this is a revised version he's got out on Peter Schiff's website. The real crash. Peter Schiff at Euro Pacific Capital. You see the billboard over your shoulder. Also, Schiff Gold. Peter Schiff, thank you for joining us today on USAWatchdog.com.
And my pleasure.